Hello and welcome to The Average EV. Today we are going to be talking about the Clean Vehicle Tax Credit, also known in the EV space as the EV tax credit. Effective January 2024, there are some changes, and I wanted to remind everybody about those changes and also go over all of the old requirements that are still going to be in place. Let's get into it. All right, everybody, so this is going to be a longer video. I'm going to break it up into a bunch of chapters. Please feel free to come back as you need to kind of go over specific parts of the tax credit so that you can gain clarity and know what's going on if you're interested in claiming the tax credit. Before I talk about anything, I just want to remind everybody that I am not a tax professional. I just happen to know a lot about the tax credit and have also taken advantage of it myself. And I want to give you all a clear understanding about the tax credit so that you can make proper decisions. So what does that mean? What that means is before you make any financial decisions, please be sure to go over them with some sort of tax professional or financial advisor. You can use all of my information as reference, as all of it is based on fact and what I have gained from doing my research. But do not make any final decisions based off what I say. Make sure you talk to some professional who can give you the most solid information for your particular scenario, because there may be some things you don't know about your financial situation that might actually not work with the information I give you. Maybe you have more non-refundable credits or something like that. So please be sure to talk to them, and then you can make your decision. That is all I'm going to say about that. And now let's get into the main bulk of the video. So with the Clean Vehicle Tax Credit from the IRA, also known as the Inflation Reduction Act, there were some changes, and a really cool change that I'm going to talk about later is the point of sale credit, which I'll get to later. So please tune in so you can learn about that and what that might mean for you and your EV purchase in the future, starting January 1st, 2024. For taxpayer eligibility, this has stayed the same since the beginning of the tax credit with the Inflation Reduction Act. So your adjusted gross income may not exceed $300,000 for married couples filing jointly, $225,000 for heads of households, and $150,000 for all other filers, single, etc. You need to buy it for your own use. And lastly, you need to use the vehicle primarily in the United States. Now, for the credit amount, you can claim up to $7,500 in credit. However, it's broken up into two pieces and a couple other caveats. So first, you get $3,750 of it if it meets the critical mineral requirements. I'm not going to go into detail about that, but I will give you a link that will basically tell you how much the vehicle you're interested in will qualify for. And then you get another $3,750 if it meets the battery component requirements. And basically for both of those, they're just wanting things to be made in the US or from some kind of free trade partner agreement. I believe the minerals are free trade and the battery component requirement is made in the US or North America, actually. The credit is also tied to the battery size, but all modern EVs have big enough batteries and will qualify. I am making this video from the lens of someone who wants to buy an EV, not a plug-in hybrid electric vehicle. If you are interested in the plug-in hybrid electric vehicle, if you leave it down in the comments, I could tell you or direct you to information to help you make a better decision. Next, qualified vehicles, which I was talking about a little bit there. So they have to have the proper battery capacity, like I said, all EVs do. Have a gross vehicle weight rating of less than 1,400 pounds. Be made by a qualified manufacturer. Undergo final assembly in North America, so parts can be from other places, but it needs to be built in North America. meet critical mineral and battery component requirements. We just talked about that. And the MSRP, this is something you want to pay attention to, cannot be greater than $80,000 for vans, SUVs, and pickup trucks, and it may not be greater than $55,000 for all other vehicles, so cars, hatchbacks, stuff like that. Tax liability. This is something that confuses a lot of people and makes this challenging, and sometimes people make poor decisions because they don't know what this is. So tax liability is the full amount of taxes owed to the federal government. So every year you owe taxes to the federal government. I owe taxes to the federal government. And that is my tax liability. Throughout the year, hopefully, you're having taxes taken out of your paycheck, and that's getting paid to the IRS to pay off whatever taxes you are supposed to owe. You can do all sorts of things with your taxes so that you either get no money back at the end of the year, or you get some money, or some people, they end up owing, which is unfortunate, but it does happen to some people. So as far as tax liability for the EV tax credit, this is what you really want to pay attention to and what people get confused on a lot. So first off, you must have at least $7,500 in tax liability to receive the full credit. I have a couple examples later, but basically you have to pay $7,500 in taxes to the federal government to be able to claim the full benefits of this credit. If you only pay, say, $4,000, and that's all you are supposed to pay the federal government, then that's all you're going to be able to get back. So what is your tax liability? This is based on your taxable income, so however much you make throughout the year, and then that's minus the standard deduction, which for this year, 2023, is $13,850 for single filers, $27,700 for joint filers, and $20,800 for heads of household. The minimum income to qualify for the full credit. So I gave these to give everybody a little bit of an idea. Well, how much money do I need to make in a year to be able to qualify for the full credit? Now, these amounts include the standard deduction removed. So if you make $69,300, you'll subtract the standard deduction from that, and it'll end up being, $56,000, and that is, the taxable amount, and then whatever the tax liability is. So to qualify for the full credit, if you're single, you need to make approximately $69,300. That is your gross income. For married filing joint, you need to make approximately $93,900 combined. And then for head of household, you need to make approximately $83,550. If you make these amounts, your tax liability is going to be right at $7,500. If you make more than that, then you will definitely qualify for the full $7,500 based on your tax liability, assuming you have no other non-refundable credits that you are taking advantage of. That will obviously affect your credit. If you make less than the above, you will receive a partial tax credit based on your tax liability. So like I said, if say you make, $50,000, $60,000, and maybe $50,000, and your tax liability is just $6,000, then you can only get that $6,000 back. You're not going to get that additional $1,500. So I've been saying this a couple times, and I want to define it for everybody. So a non-refundable tax credit is a credit that reduces your tax liability to a minimum of 0, meaning you cannot get extra money back. Okay, so you can only reduce your tax liability, so basically you owe no taxes. Again, clean vehicle credits are non-refundable. You can only reduce your tax liability to 0 when claiming the clean vehicle credit. If your tax liability is less than the credit, you will only receive a credit equal to your tax liability. I've talked about that just previously. So here's an example. If your liability is $5,000, your credit will be $5,000. If your tax liability is $10,000, you will get the full $7,500. Okay, so hopefully that makes it really clear. If you're still not sure, you can just post right down below, and I promise I will respond. Since this is not a refundable credit, you will only get money back if you actually paid the correct amount of taxes, since it reduces your tax liability. So here's an example, just to make this really clear. You make $70,000, and you owe the IRS $7,660. So over the year, you pay exactly the amount you're supposed to pay the IRS. Good for you. You purchase a new EV and you plan on claiming that EV tax credit here at the end of the year. Your tax liability, since you're claiming the tax credit, is going to be reduced from $7,660 to $160. So that's all you're supposed to pay the government. However, you've already paid them $7,660. So what that means is when you file your taxes, since you've already paid that $160 and you've paid the $7,660, you're going to get the full $7,500 credit back in the form of a refund. Now, but you said it's not refundable. It's just, I know that's really confusing, but when you pay more than you're supposed to the IRS, they refund you your money, and which is great. The non-refundable just means you can't get more than your tax liability. So I hope that's becoming a little bit clearer. It is very confusing, and that's why I'm trying to make this video. Again, if you're still not sure, comment down below. I will help clear anything up for you. This is a scenario that happens sometimes. If you underpay your taxes, a lot of people, they like to pay the exact amount so they have the most money throughout the year, which is a great philosophy to have. And so they do that, but maybe they accidentally underpay their taxes. So your tax liability is still going to be reduced, but you may not receive the full tax credit depending upon, all your specific scenario. So here's an example. It's the same as before. You make the $70,000. You owe $7,660 in tax to the IRS. But this time, over the year, you only pay $4,660 in taxes instead of the full amount. So you're paying $3,000 less than you should have. And theoretically, without the tax credit, you're going to owe the government $3,000, which would really stink. So now you purchase an EV and you claim the tax credit. So now what happens is your tax liability is still $160 now. And you paid the $4,660, but you should have paid the $7,660. So you subtract the liability of $160, it's $4,500. The credit is $7,500, so you take the $7,500, subtract the $4,500, that leaves the $3,000 that is going to get paid back to the government. However, you are going to get that $4,500 back as a refund when you file your taxes. So in a way, if you kind of like messed up your deductions and stuff like that, it can kind of actually help you out. Sorry, withholdings. It can actually help you out a little bit if you put yourself in a scenario that is not ideal. So this is the reason I'm making this video. Starting in 2024 and beyond, you can claim the tax credit at point of sale. And this is really exciting to help lower the initial entry cost of EVs and hopefully encourage people to want to buy an EV because it'll lower that entry price. So here's a little bit of information about it, but there's definitely some nuance to this. The tax credit is transferred from the buyer to the dealer, and then the tax credit amount is deducted from the sale price, reducing the total upfront cost. This is really good because it helps, will hopefully help a lot of people be able to get into EVs without having to wait on getting the money back, which a lot of people couldn't do. Now they can claim it at point of sale, they can get into the EV, and then they don't have to worry about waiting to get that money back whenever they end up filing their taxes. So a dealer must be registered with the IRS to have the credit transferred to them. They should know how to do that. They should have received that information. And obviously that's something you're going to want to confirm before buying the car from your dealer. You will still have to claim the credit on your tax return for 2024, but you will just have to note that you received it at point of sale. So that'll be pretty easy and nice to deal with. So here are some of my concerns with the point of sale, and this is now my opinion a little bit based on some research I've done. If you claim the credit and do not qualify because you make more money than allowed, you will repay the full credit back to the IRS. So you have to know whether you qualify or not so that you don't end up having to pay money back to the government. All right, so this is a part you really want to pay attention to because it's kind of convoluted. According to the written law, so what is in the Inflation Reduction Act, you would only qualify for part of the credit due to tax liability less than $7,500, and you would have to repay the difference. So say you only qualified for your tax liability is $4,500, you should only get $4,500 and have that applied at point of sale. But there's actually been a lot of controversy. I don't know how much you've been following this, because the IRS then came in and they have, I guess, the rules that they're actually going to implement, which is contrary to the written law. So again, at point of sale, you should claim the full amount and have a liability of $6,500. You should owe the IRS $1,000. But the amount of the credit, and this comes directly from the IRS website. I will have everything linked down below so you can check all my sources. The amount of the credit that the electing taxpayer elects to transfer to the eligible entity may exceed the electing taxpayer's regular tax liability for the taxable year in which the sale occurs. And the excess, if any, is not subject to recapture from the dealer or the buyer. So basically what this is saying is, if your tax liability isn't $7,500, you claim the full $7,500 at the point of sale. According to this and what I've read, you are not going to pay it back, or at least the IRS is not going to come after you. That is my understanding based on this. However, it is my strong opinion, since the guidance contradicts the written law, I would only claim what you should claim. If you want to take the risk and do the $7,500 and it works out, great. But I don't like taking risks like that because I don't want to have to end up owing a couple $1,000s to the IRS. So I would find out what my liability would be and make sure I'm only claiming my liability amount. Because in the future, if there's a different administration or something like that, they could potentially change the guidance, and then you're going to be in a rough situation, which you might not want to be in. So again, that is as of right now, it's December 2023. This is going to go into effect in January. It could change in the future, so double check if you're watching this really far into the future. But I always like to err on the side of caution, and I don't know about you, but I don't want to have to pay that much money to the government unexpectedly. Now, with the Inflation Reduction Act, there's also the used clean vehicle tax credit, which I'm just going to go over briefly. Pretty much everything I talked about in principle applies to the used clean vehicle tax credit. You can also claim this at point of sale, which will be really nice. So I'm just going to go over this real fast. The adjusted gross incomes have changed from the new to the used. So it's $150,000 for married filing joint, $1,000, $1,200, $500 for heads of household, and $75,000 for all other filers. The sale price of the vehicle has to be $25,000 or less. You will get a credit of 30% of the sale price up to $4,000. I forget the exact, I think it's like 12 to 15,000. I forget. You can do the math. That's around 30% is 4,000. Run the math, 30% times the price, and that is what credit you'll get. The model year must be 2 years earlier than the current year. So right now it's 2023, so you can get a 2021 or earlier. In 2024, it'll be a 2022. A 2022 or earlier. You may only claim the credit once every 3 years. This varies from the new clean vehicle tax credit, which you can claim as many times as you want, actually, up to your tax liability or beyond if you really want to pay money to the government. But for the used, it's only once every 3 years. And you can only, not just you, anyone can only claim the used vehicle credit on that specific vehicle once. So once someone claims the credit on that vehicle, it can no longer get the credit. And I think that's because they want to avoid people from buying cars and selling them to kind of rip off the government. So just remember the following things when you're considering any of the clean vehicle tax credits, because it is a really awesome opportunity to get people into EVs to help increase EV adoption. But you definitely don't want to make mistakes that you're going to have to pay for later in the future. So first, always consult with a tax professional. I am not a tax professional. I'm just giving you my knowledge and guidance based on my experiences. If your situation is similar to the previous year, check your tax return to see what your tax liability was, and then you have a pretty good idea of what your tax liability will be for the next year. If your situation changed a lot, then you're definitely going to want to wait, double check when you file your taxes, or obviously double check with your tax advisor or anything like that. Eligible vehicles may change. Do not count on the credit until you know for sure from your tax professional. So don't assume the tax liability you will have. Make sure you know. That way you don't put yourself in that bad situation. And lastly, eligible vehicles may change year to year or even within the same year. Be sure to confirm that the vehicle you want is eligible. Okay. Right now, there's all these Teslas 2024 that will no longer be eligible because of the battery component. There's, I'm trying to think, there's a couple other manufacturers that also announced that they're not going to qualify at all, or at least only for half. So make sure you double check, because there's honestly not that many in 2024, not that many vehicles that are even going to be eligible at all. The one I know for sure will be the Volkswagen ID4. I haven't heard anything contrary, and they had come out and said that they were confident that they will qualify. If that changes, I'll leave something down below. But I'm also going to leave a link to a website where they keep it updated of what vehicles are eligible. And as long as you use that, and as long as it's eligible at the time of your purchase, you'll be good. If you buy it and it's eligible then, you're good. Later, if it changes and it's not eligible, you're still good. It doesn't change like if you buy it just because you bought it now and it changes later with later vehicles that are produced with batteries that don't qualify, you're still good. So don't freak out about that. Everything's going to be all right. So again, that's the video. It was longer, but I wanted to make sure I was really clear, give some scenarios, and make sure you all can make good decisions before you had to reach out to your financial advisor or a tax professional. So there it is. I hope you enjoyed this video. If you have any questions or comments, please leave them down below. This is a really confusing subject. I've actually done another video. I'm not going to link it because it's pretty much the same information, but with some updates. But that video did really well, and I was able to help out a lot of people, and they left a ton of comments. So please feel free to leave comments so that I can help you out and give you a little bit of my perspective on your situation. So thanks again for watching. If you haven't already, please give a like and a subscribe. That really helps my channel so I can bring helpful content to people who want to join the EV revolution. Again, thanks for watching, and I'll catch you all next time.